Business News, where news for business people.
Hello and welcome to Bloomberg Quint Live, and you're watching Trend Spotting. I'm Navneet Saluja D'Souza.
Hi Navneet, I'm Agam Akil. In the next 30 minutes, we deep dive into specific trends in the markets to draw out its key takeaways and implications for investors. But first, the headlines. Monday blues on the last street as markets slip into consolidation mode, with the Sensex halting its two-month winning streak. And Larsen & Toubro wins orders worth well over 3,500 crores across four verticals, including transport, infrastructure, metallurgy, power and building construction business. And Adani Group shares fall as Labour government is favoured to return into power to the northeast Australian state. And oil marketing companies like BPCL and HPCL have taken a backseat after slipping over rising crude oil prices.
Okay, let's take a look as to what's happening with the markets. Clearly, it's not been a great start to the expiry week. Both Nifty Sensex have been trading in the red, but they're off days low. Currently, Nifty is trading around those levels of 10,358. But there has been a recovery that has been seen for Bank Nifty owing to the Nifty PSU banking space. Remember, when the markets opened today, that index was down as much as 1%. So there has been some intraday recovery, as you can see in the intraday chart. But in terms of sectoral indices, you've got the Nifty Media as well as the Nifty Realty Index, which are bucking the trend in today's trade. Stocks like TV18 Broadcast, Dish TV from the Media Pack, and Indiabulls Real Estate and DLF, which has come out of the F&O ban from the Realty Pack, are buzzing in today's session. What's not doing well, the Nifty FMCG Index has seen cuts of as much as 0.6%. Stocks like Imami, that's been trading in the positive, but what's dragging the index lower are the likes of Godrej Consumer and Tata Global Beverages. These two counters are your biggest laggards in the Nifty FMCG Index. Let's also pull up the advance decline ratio. So far, it's been in favor of the advances, almost 3:1, because the broader markets today are outperforming the benchmark indices. We've seen some green ticks coming in there. There you go. NSE stats almost 3:2. If you could just pull up the contributors list of NSE, that will clearly tell you which are the stocks which are contributing to today's gains or losses. Axis Bank, NTPC, L&T, UPL are their top contributors, whereas the laggards are Infi, ITC, HDFC, as well as IndusInd Bank. What about the broader markets, Agam?
Again, Navneet, as you've already mentioned, that the broader markets are looking good with more advances than declines. And in terms of some of the key movers and shakers, I am looking at, well, advances in Bombay Rayon, again, up as much as 9.7%. We have GHCL also advancing. Navneet, you already mentioned TV18 Broadcast, which is also up as much as 7%. And we have some unusual ones as well. So Inox Wind up 6%, Neel Kamal up also 6%, followed by Varun Beverages, Videocon Industries and Mindtree all gaining anywhere between 4.5% to 5%. In terms of losers, we have weakness in Lakshmi Vilas Bank, which is down 5.4%. NIT Technologies also down as much as 3%. And some other counters like Godrej Consumer Products, Future Lifestyle, Edelweiss Financial and Gujarat Minerals losing a little over 2% in today's day of trade. But once again, the market breadth is in favor of advances.
Okay, so some positive to this new week, but let's move on Trend Spotting today. We first discussed Nifty and its constituents since the Lehman Brothers filed for bankruptcy. We also discussed the growth drivers and road ahead for Blue Star as we connect with the Executive Director, Mr. B. Thiagarajan. We get an analyst view on what's making brokerages so positive on Motherson Sumi as we connect with Prayesh Jain of IIFL Wealth. All right, then moving on to our first trend. It's been more than 9 years since the Lehman Brothers filed for bankruptcy, taking the wind out of equities across the world. It was, in fact, the largest global sell-off since the 1990s. A lot has changed since then, with equities showing resilience and the emerging markets like India attracting more foreign investments than ever before. So how much would a brave few who decided to take the plunge back then by buying buying the Nifty stand to gain right now? Darshan Mehta has done some calculation. Darshan, take us through your analysis.
Yeah, so basically, Navneet, what we've done is that we've taken the constituents of the Nifty that was there on 1st Jan 2009, and what's happened. So the Nifty will have constituents like Unitech as well as Suzlon. So Nifty market cap was almost 19 lakh crore at that on 1st Jan. Right now it's almost 75 lakh crore. So there has been some tremendous amount of shift that has happened as far as the Nifty is concerned. Basically, a lot of stocks have outperformed and some of them have even underperformed. So majority of them have outperformed. Nifty itself has given returns of 240%. So from Ranbaxy and above, these counters have given returns in excess of what the Nifty did. And there are some who, like Reliance Power, Unitech, Arcom, BHEL, which have given negative returns for the investors ever since the 1st Jan. So clearly some of them have been marked outperformers, some of them have been underperformers. Now basically 24 stocks outperformed the benchmark indices and 10 gave you negative returns, and you'd see counters like Unitech and Arcom, R-Power, these were the ones. Some changes happened. Cain, Sesa was merged into Sterlite, and Cain was again merged and that formed Vedanta. The other changes that happened on the Nifty constituents was Ranbaxy was merged into Sun Pharma. Apart from it, Reliance Petroleum was into Reliance Industries, and finally the scam hit Satyam went into Tech Mahindra. So this is the broad contours of what has happened. Now basically Nifty is up almost 3.5 times, but a lot of what we did was that we found out, we put that if you put 50,000 on the Nifty on 1st Jan and or you put 10,000 each in all the 50 Nifty stocks and held it to now, what would the returns be? So on a Nifty basis, if you're looking at it, the return was 242%, but if you manage to put money in all the stocks and hold it, you would have made 25% more returns than what you made as far as the Nifty is concerned. So that was basically, basically the entire trend for the Nifty over the past 9 years.
Well, Darshan, you also have another very interesting trend that if you would put like a certain sum of money in the index as against the index constituents, there is still a big difference there.
Yeah, so that is right, because what has happened is if you look at the Nifty, 50,000 if you put on the Nifty, that has become almost 1,21,000, and 1,000 each in 50 stocks, making it 50,000 would have been 1,50,000. That means an excess return of 24% over the Nifty. Individually, there has been some marked outperformers like Maruti. If I had invested 1,000, the entire value would be 15,530. This includes the investment of 1,000 also. So the return of 15 times or 1,453%. HCL Tech return of almost 1,300%. Your 1,000 would have been worth almost 14,000 rupees today. There are other counters like Tata Motors, return of almost 12 times currently. You had counters like TCS, India's second largest company, that had given a return of 10 times. And finally, you have counters like M&M, which have given returns of almost 915%. So 10,000 invested would be 10,000 rupees today. There have been some marked underperformers also. The first one being Reliance Communication. 1,000 rupees have been worth only 60 rupees because market share erosion or market cap erosion of 94%. You have counters like Unitech. 1,000 rupees would be worth only 140 rupees, market return of negative 86%. Suzlon again down 76%. You have counters like Reliance Power and BHEL, both of them giving significant amount of negative returns, 70% and 50%. So that's the broad contours. But just for fun sake analysis, let's take some of the counters which if you had invested 10 lakhs in Maruti, you would be able to buy an Audi RS7 which cost 1.6 crores. So that's the power of compounding. If you put 10 lakhs in HCL Tech, you could buy a BMW M series which is worth almost 1.4 lakh crores. If you put 1,000 in 10 lakhs in Tata Motors, you could buy this Range Rover which cost almost 1.3 lakh crores. In TCS, you could buy this Jaguar which cost almost 1.1 crores, and finally a Porsche Cayenne if you invested 10 lakhs in M&M. So these are the counters that have been managed to be a significant amount of outperforming in the last 9 years.
Well, clearly, Darshan, it's the autos and the IT stocks which are featured
that's right, because
on the top.
Normally what had happened was if you look at the constituents, if you had invested in the top sectors, so if you had invested in auto and IT, you would have made a lot of money, and if you had invested in power and infrastructure, real estate, you would have lost significant amount of your money.
All right, Darshan, thanks a lot for bringing that very interesting piece of analysis. Clearly, someone who would have taken that plunge in 2009, Agam, would be sitting on huge amount of profits. As they say, one has to have that contrarian view and when it comes to markets. All right, let's move across to our second trend of the day then. It's been a year of steady gains for Blue Star, with the counter advancing over 47% so far in this year. What have been the key factors at play aiding and denting the stock? In fact, let's ask ask the management. Joining us is the Executive Director, Mr. B. Thiagarajan, who's joining us on the show now. Good morning, Mr. Thiagarajan, and appreciate you joining us today on Bloomberg Quint. Well, my first question to you is, from what we understand, Blue Star is in that investment mode for some of its key segments. If you could tell us what are these key products, and can you also elaborate on the investments that you are committing to the related product lines as of now?
I will not exactly call it as a investing mode or something like that. The very first thing is that we are on a growth mode. The consequent demonetization and subsequently GST, there were some kind of slowdown in the market. We need to revert to growth path in line with the market and try to exceed the market growth. So growth remains an important priority. There is no doubt about it at all. The second one is with regard to the profitability and the margins. Commodity prices have been going up, and we consume a lot of metallurgical items, steel, copper, so on and so forth. Therefore, how we will go ahead and correct the prices and also optimize the designs in order to protect our margins. So this is the second priority. The third priority is with regard to the excellence in whatever we do. We are a successful player, leaders in most of the product categories in which we operate, basically because we have differentiated offerings. We have positioned ourselves as experts in this business. So therefore, investments will have to go in terms of offering that excellence to the consumers, both in terms of goods sold and services rendered. So there is a program on project execution excellence, there is a manufacturing excellence program, there is an after-sales service excellence program. Those investments continue to take place. The next one is with regard to the penetration. When we say our all India market share has touched to 12% in room air conditioners, it is not across the country we will have that kind of a market share. There are pockets, say in northern India, Uttar Pradesh, or Bihar, or in northeast. Our penetration is low, and while distribution network expansion is going on, we need to invest in brand building, or basically the advertising as well as field marketing initiatives. Those investments continue. The next important one is the water purifiers business, where other than the air conditioning and the refrigeration part of it, there are two areas in which investments are going on. One is the water purifiers business, where it is an independent business unit pursuing purification of water for residential space, and that business is scaling up now. We need to persist with our efforts in that area so that we position ourselves as one of the key players in that product segment. The other area is the exports. The international business, we are expanding our footprint in Middle East as well as Africa and Far East and SAARC countries. That investment will continue. Lastly, the manufacturing capacity requirements in line with our growth. We foresee we need to expand our manufacturing capacity for room air conditioners, for refrigeration products like deep freezers or water coolers. Somewhere in 2020, we need to have additional capacity. So we went ahead and invested in land in Jammu as well as Sri City in Andhra Pradesh. Jammu project is conceived based on certain excise concessions at that point of a time, translating into GST benefits. Those benefits do not seem to be available as per the latest notification that is available. We are awaiting further clarification. In case the excise equivalent, which is the CGST benefit, is not available from Jammu, we may not be able to continue with that project. So that decision will be taken soon. Then we will go ahead with the expansion activity in Sri City. In the meanwhile, for FY19 or most part of FY20, we do not see any kind of a capacity constraint in terms of manufactured products at all. So therefore, when I want to again emphasize that our top priority is growing better than the market. The second one is protecting the profitability and improving it. The third one is differentiating ourselves through the excellence programs in manufacturing, project delivery, in service, in whatever we do. And the next investment is the penetration, therefore Blue Star brand building in those markets so that we have enough customer pull. Water purifier business and international business as additional area.
Okay, so Mr. Thiagarajan, I was also going through your positioning in the AC business, and that market share stands at around 10 to 11%, and in India at least. And currently, some of your products are also priced at a premium. So I want to understand how you have positioned yourself when it comes to your air conditioning business, and if you could tell us also a little more about what your strategy is, keeping in mind competition when it comes to your ACs business.
Between growth in market share and profitability, I think our interest will be growing profitably. We don't want to buy market share at all. So this has been the principle for many decades, and we continue to do so. Second one is that we should offer globally competitive products, world class, the latest and the best. So if you look at any of the products that we offer, they are superior, world-class, comparable to the best in the industry. If that is the case, it gets positioned as a premium offering. So our own brand positioning is like that. Now, whether the product is available in all price points, in some cases it is not so. Like water purifiers, when we entered, we occupied the top-end products, basically because we wanted to target the market, build an image there, and then go down to offering products at various price points. Similarly, in room air conditioners, we may not have products for certain markets, like let us take, for example, Uttar Pradesh, Bihar, the Punjab, where it is highly price sensitive. We may not have a product offering. Even in those markets, we want to be a differentiated premium player rather than run-of-the-mill kind. And that has been the philosophy in our marketing all along. And therefore, whether we have an aspiration to become a number one player in room air conditioners, number one in terms of the products that we offer, yes. But in terms of market share that I have to buy and be in all segments of the product, I don't think so. It is not, the companies have to make a choice, and in our case, we have made this kind of a choice. And therefore, we will try to grow more than the market, anywhere between 5 to 10%. In some quarters, it may not take place, it is perfectly fine. But in the long run, in room air conditioners, we would like to grow anywhere between 500 to 1,000 basis points more than the market, so that our market share grows to 12.5. This year we will end up around 12% market share. And the next year we should attempt anywhere between 12.5 to 13, and the year after somewhere around 14. So it will have a limitation. You will not be able to say that I'm going to be a 25% market share holder. In many other products, we have more than 30%. Take packaged air conditioning. Take the scroll chillers that we offer. Take water coolers that we offer in cold rooms, in deep freezers. These categories, we dominate the market close to 1/3 share. And this has been our strategy. We will continue to pursue that.
Okay, so you're looking to get about 12% market share for this financial year in the AC segment, and next year could be almost 13%. But reports do suggest that low margins in the electromechanical space are bottoming out, and they will improve from here on. If you do agree to that, could you tell us what will exactly drive the margins for the company from here on?
In electromechanical projects business, after many years of experiment, we have decided that we will be very selective in terms of bidding for the jobs, number one. It has to be profitable. It has to provide positive cash flow. And these two considerations are very important. Therefore, we bid for projects where we feel confident that the project will get completed in time and there is sufficient profit that is available, the payment terms are good. This is how we have been pursuing. In the process, we are now seeing there is, in terms of financial discipline, it is excellent. Execution discipline, excellent. Cash flows are very good. I won't say it is good compared with the previous years. Now, in this situation, what we have to wait for is the opening up of the construction cycle. Unfortunately, it is not taking place for one reason or other. There was demonetization, there was a RERA Act, and so on and so forth. Actually, the commercial construction boom is not yet there. It will happen at some point of a time. In the meanwhile, we will continue to grow, basically because we have been very choosy. We are starting from a lower base. Year on year, that business will continue to grow, and there is absolutely no doubt about it at all. Coming back to the commodity prices, it is most items are going up, and fortunately we had a control over the foreign exchange till now. I have a feeling even foreign exchange issue may come up again, and it is a tightrope game, but we will ensure that our top line grows, our bottom line grows. And in the process, we are not able to get market share. It is perfectly fine with us at this point of a time. The primary importance is growth, and that too profitable growth.
Mr. Thiagarajan, thanks for joining us and giving us those details on Blue Star, perhaps on the outlook as well. But we'll move on to our next trend, and this is Motherson Sumi, which has recently highlighted its plans to go beyond just the year of 2020. And while the auto ancillary maker doesn't see a huge impact of electric and driverless cars on its core business, the company is now looking to go beyond the auto sector. The counter too has done well to gain well around 60% through the course of the year, and brokerages once again remain positive when it comes to the outlook on the stock. So what is it that's triggering this view? To answer this, we have on the phone line, Prayesh Jain, Assistant Vice President, joining us at research at IIFL Wealth. Hi Prayesh, thanks for joining us. Prayesh, firstly, let me ask you what you have made of the comments of the management when it comes to their FY20 revenue target of around $18 billion. That's one. And the second part is whether or not you think that they can achieve that particular revenue target, considering what they have in terms of pipeline.
Yeah, good morning. See, the thing is, with regards to their $18 billion revenue target for their Motherson Sumi and $26 billion for their combined entity, that is Motherson Group, I think, organically, while all the segments of the company are likely to see very strong traction, but organically to achieve that, it would be a very difficult thing to do, and they would need an acquisition, but the company clearly outlined that acquisition will not be at the behest of any margins going down or just going for the sake of achieving that target. The key important parameter would be under check that the ROCE of the acquired company should be able to scale up to 40%, and it should be given backed by customers' references. So also, while that $18 billion organically looks difficult, but an acquisition would be a key to that.
Okay, well, we did hear from the management. We'll play out that, but they did mention they will be looking at the inorganic route, Prayesh. What I also want to understand, the management, along with its Vision 2020, they've also said that they would be diversifying and looking at non-auto segments for the likes of aerospace, defense, or security verticals. What have you made of it? And according to you, what do you think can be the prospects in the non-auto sectors for the company?
Yeah, definitely. These are segments which have large order books and large things, but already companies would be supplying these components. So definitely the company will have to compete in this industry, and it will not be as simple as they've found it in the automotive industry to gain market share. So it would be, while it's at a very nascent stage right now, the opportunities are large there, and the capabilities of this company are also pretty strong. So definitely we see that there is a lot of potential in this.
Prayesh, if I look at the businesses when it comes to Peguform or for that matter Reflectech, that is SMR and SMP, what I wanted to understand was the outlook of margins in these businesses going forward, considering the kind of investments that are going into this company. Do you think that we could see a further improvement in margins going forward, or do you think that they will be around the same level at least for the foreseeable futures? And I'm not talking about just 2 quarters, but maybe the next 6 quarters.
The Peguform business, we see there is a lot of margin traction that can come in. One of the points that needs to be taken to be seen is the fact that the Peguform has set up new plants, and those operations would scale up in the near future, and that would mean better utilization, and that would mean higher margins. Even also point to be noted is this business was acquired in 2011, which came along with legacy orders that would possibly be at lower margins, and the contribution of that should reduce substantially going ahead, and so that would mean better margins. Peguform business should see margin traction, but on the SMR side, I think some vertical integration and revenue scale up should help them, and rising content per vehicle should help them improve their margins a bit from here.
Prayesh, quickly, what's the house call that you guys have, and how much more upside that one can look at from the current levels of 353?
And also, Prayesh, if I may add to that, are you factoring in FY20 as at around $18 billion in your price target, to add to Navneet's question?
See, obviously, we are not factoring in with $18 billion revenue, because there is, as I mentioned earlier, that without an acquisition, we don't foresee that happening, and so we cannot build an acquisition. So in that sense, we are not building $18 billion revenues for FY20. And with regards to the house call, we have it a buy recommendation with a target of 470, and it is our top recommendations in the auto ancillary space right now.
Okay, Prayesh, thanks for joining us and taking us through your outlook on Motherson Sumi. But of course, earlier today, we also spoke to the chairman, Vivek Chand Sehgal of Motherson Sumi, to discuss the impact of shift to electric vehicles business on the auto components maker. Here's what he had to say. Listen in.
It's not a disruption, it's just another option to drive the car. I mean, there is no, whatever the hype that people are creating, we are okay with that. As Motherson, we are agnostic to it. But I feel that it is a bit overdone. There's a lot of possibilities. It's a very exciting thing. But the first Porsche made in the world was an electric engine. So people have already been there and come back. There are certain challenges. Those particular challenges have to be overcome. And depends upon how fast the world will react to these requirements. And if they react very fast, all the governments react very well, well, it's going to happen maybe in 10, 15, 20 years. So we are okay with that. And it also opens up tremendous amount of opportunities for existing technologies to also disrupt this electric vehicle. So, you know, we can go on.
Okay, with that, it's a wrap on this edition of Trend Spotting. Don't go anywhere. Up next is Hot Money. Stay tuned to Bloomberg Quint Live.